How do we handle tax filings or possible tax debts tied to a business the deceased person may have had in another state? In an estate administration, the personal representative generally has to identify and deal with the deceased person's and the estate's tax filing duties before the estate can be safely closed, even if the possible tax issue comes from business activity in another state. Start by confirming what tax returns were required and what was actually filed, including the possibility that past returns were filed jointly with a spouse. Then determine whether there is a final individual income tax return due for the deceased person, and whether the estate has to file its own fiduciary income tax returns during administration. Next, focus on where the income or business activity happened, because another state may require a non-resident return or business-related filings, and that can create a tax debt the estate must address. Practically, this usually means gathering records, working with a certified public accountant or tax attorney to request tax transcripts and verify any balances due, and coordinating with a professional in the other state if needed to confirm that state's filing and payment rules. If taxes are owed, they are typically paid from estate funds, or the personal representative sets aside enough money to cover the expected liability while it is being finalized. The key point is that the estate should not make final distributions or close out the final probate accounting until required state taxes have been paid or otherwise secured. Also watch the timing. If the estate must file a fiduciary income tax return, it is generally due by the 15th day of the 4th month after the estate's fiscal year ends, unless an extension applies.